Hey, everybody. Welcome back to the Daily Gold podcast. Now, this is something new for the Daily Gold podcast. I have been doing CEO interviews for the Daily Gold premium subscribers, covering our premium companies. And, I found that very rewarding, but something I want to do is open up the interviews publicly and interview a broader range of companies. So I'm really excited. I think this is going to be worth your time and worth my time as well. I think it's going to help you and help me with respect to our due diligence. And so with that being said, our first company interview in this series is with Osino Resources. I'm very pleased to have Haya Don, the founder and CEO of Osino Resources, with me today. So Haya, let's dispose of the pleasantries and get right to the interview. First things first, why don't you give us a background on Osino Resources and also your current market cap and current cash position?
Great. Thanks for having me, Jordan. So we're a gold development company active in Namibia. We're listed on the TSXV under the ticker OSI. We started the company in around 2016. Initially, we were an exploration company, but we progressed fairly quickly. We made a greenfields discovery in 2019, and then 2020 and 21, we drilled the hell out of it, basically with 10 rigs constantly. And then last year, we spent most of our time, some drilling, but mostly doing feasibility studies. That's culminating now in a definitive. So very soon, we will be developing this gold project. But there's a bit of history because it's 13 years ago, in 2009, I acquired another project in Namibia, which we advanced, and we ended up selling to B2Gold, and they built a gold mine there. Very successful, cash generative, low-cost, long-life gold mine. And that project, B2Gold, really proved our thesis. With this company, Osino, we are just doing it again. So that, I guess, is the summary.
Could you tell me your current market cap and the cash position?
Oh, yes. So we've got 190 million Canadian dollar, roundabout 180, 190 million Canadian dollar market cap. What's that, like 160 or so US? We got roughly 10 million Canadian in the bank. We're not hugely financed, but most of the heavy lifting has been done. We've got some very important catalysts coming up, like definitive study, and then thereafter it's going to be project financing. So we're in that I don't want to call it the doldrum. We're in the final doldrum on the Lassonde curve, where we're progressing from development into true implementation and building the gold mine.
Okay, let's talk about the jurisdiction and get that out of the way, because Namibia, most people probably don't know where it is. They don't know anything about it, but they hear Africa and that just jumps up as a red flag. So tell our audience, why you like working in Namibia and why sometimes you say, well, it isn't really in Africa.
Yeah, let me be flippant about it. It's not Africa, it's Namibia. Of course, I'm joking. It is in Africa. It's in southwestern Africa. It's just north of South Africa. It's very different to South Africa. And in fact, it is in many respects much more similar to Nevada or Western Australia. It's a dry country, very sparsely populated. I think after Mongolia, it's the second least. It's got the second lowest population density in the world. That's a huge factor. A massive country with 2.5 million people in it. So wide open spaces, but very organized. Excellent service industry. Got some great mines there. Very well-known companies, Rio Tinto, Gold Fields, Dundee Precious Metals, B2Gold, various ones. And of course, I'm partial to it because I'm a citizen of Namibia. I was born there. My family are cattle ranchers in Namibia, so I know my way around it. So yeah, no, it really is a great country to operate in. We've got none of the stuff that people usually associate with Africa, like Kalashnikovs, civil wars, coups, Ebola virus. We've got none of that. It's a very organized country, and pleasingly, we've got a weak exchange rate. So the cost of operating in Namibia is very, very low.
Okay, very good. Now, back to the project. Now, I know you guys had the PFS last year, and you have the definitive feasibility study, which is coming up very soon, I think. Tell our audience how that might be different from the PFS, if at all.
Yes. Now, okay. So I'll answer that question first, and then I'll make another statement. The definitive is very similar to the PFS. There'll be a few extra answers, but much better definition. Remember, a PFS is largely I don't want to call it a marketing document. A PFS is a preliminary feasibility study. It is usually based on factoring and on rougher estimates. It cannot be used for financing a project. That's what a definitive is there for. So a definitive primarily gives you a much tighter capital estimate and much better granularity in terms of the project. That's why people do it. It's an expensive exercise, but a definitive can be used to finance the project and then to build it. That's why we did it. You are right, it's coming out soon. It's probably going to get published in around the middle of June. I think it's going to be mostly in line with the pre-feasibility study, but better in that we're hoping to have a slight capital saving. We're hoping that that we'll have some extra answers. We definitely will have some extra answers, but we are also being slightly more conservative. So we've evened out the production flow profile, etc. So in terms of valuation, it will probably be similar to the pre-feasibility study, but obviously much higher confidence, and it unlocks a whole bunch of other things like project financing, potentially M&A, etc., etc. That's why we're doing it. Yeah.
Just a quick follow-up on that. How much? I mean, the financing. When you get that interest, when financiers want to get involved, how much more significant is it that you have the DFS versus only a PFS? I mean, does it kind of go from 0 to 100 after the DFS, or do they start sniffing around before that?
No, very big difference. I'll tell you why. The biggest variable affecting companies like us at this stage is the question around the future equity financing, because you can never finance a project like this with 100% debt. You can get like 60, 70% debt if you're lucky, which leaves 30% equity. And that equity typically is expensive because share prices are low. And therefore it's highly dilutive. So if you, and that's the game that we have to play. These are the balls that we keep in the air. So in our case, we ran a very professional process that started about a year ago, where we appointed a specialist advisor, and they brought us roughly 8 or 10 potential financiers across the capital structure, banks, streaming companies, royalty providers, all the big names were there. And we ran that process to get the best possible deal. Now, most of those financiers will not look at you with a pre-feasibility study. They will only look at you with a definitive. They looked at us earlier on because we knew that the definitive followed the pre-feasibility so shortly after. So there wasn't a big scope change. And that has played into our hands because it's allowed us to do things in parallel, in the vein of our fast-tracked approach. In order to fast-track mining projects, you sometimes need to take a risk and do things in parallel rather than sequentially one thing following the next. But yes, it was precisely for those people that we did the definitive.
Okay, yeah. Maybe I'll come back to the financing and the equity part at the end, but Twin Hills, the main project, what's the current, I mean, tell us about, the resource, the type of deposit it is, the grade, the exploration potential.
Yes. So of course the official numbers of the pre-feas, but the definitive is going to be similar. But so the pre-feas numbers, which came out, by the way, it's very recent. It's only 9 months ago that the pre-feas came out. We have a mineral resource of, I forget the exact number, just over 3 million ounces, 3.2 million ounces or so, at an average grade of 1.1 gram per ton. Our geology is very consistent, which is nice. 1.1 gram per ton might feel low, but remember, you must compare apples with apples. So this is a sedimentary hosted, structurally controlled deposit. In fact, for your American audience, it's very similar to the Carlin Trend. And remember, in the Carlin Trend, Barrick and the big boys, they mine at 0.5 gram per ton over there. We've got 1.1 gram per ton. So we've got good grades with high grade shoots, etc., and similar geology. We obviously, the resource is a measure of the inventory. You then put economics around it and you do a mine plan. We did all of that. And we came up with an open pit mine plan that produces, on average, it was around about 170,000 ounces per year over a 13-year mine life with higher production up front. So this is for those of your viewers who maybe not have a handle on those numbers, this is a quality tier 2 mine. It has a potential to get to 200,000 ounces a year. At that level, you would become interesting to even the big boys, like the senior gold producers. But we would be of interest for the mid-tiers, or we can build this project ourselves. In fact, at the moment, we are executing our standalone plan. The capital cost was around about 375 million US, which is a lot relative to our market cap. It's double, it's more than double than our market cap, which brings you back to your financing question. But in the North American context, it's actually quite reasonable on a capital intensity basis, measuring the capital divided by the gold production or the capital divided by the processing plant throughput. This is quite low capex. So it's quite a digestible mine in terms of the capital. I mean, there are not many other development projects like this around, even on a worldwide basis. The handful that are around, I'm talking about like Marathon Gold, G Mining Ventures, Ozone, these kind of companies, their capex, Ozone not, but most of the North American ones, their capex is a lot higher. So good numbers. It's a quality project. It's got very respectable production rates. It's low cost, both in terms of capital, but also operating costs. We're in the lowest quartile of the cost curve, $940 per ounce all-in sustaining costs. Sorry, these are all very technical numbers. But yeah, so it's a high-quality project that will be built. It's just a question of, are we going to build it ourselves? Or are we going to build it with somebody else? And how are we going to finance it? These are the motions that we're currently going through.
Right. Yeah. I could, ask you three different follow-ups, but one question that's interesting, you look at the AISCs, the all-in sustaining costs from some of the larger companies. I mean, they're absolutely terrible. And you look at, yourself and then other companies who have good development projects, the AISCs are so much lower. I mean, it would seem that these companies would at some point want to start, picking off the Osinos of the world, basically.
It's happened. I don't know if you saw lately, there have been a couple of, obviously they're the big deals like Newmont bought Newcrest, but there have been smaller ones like Chesa Resource, and AISC listed African developer. Actually, it's got it's got a third of the size of the resource of us. It was sold for just under 100 million US. It was sold to Fortuna Silver. So the silver companies are active. And even the gold companies are active. So you saw B2Gold bought Sabina in the Arctic. So without a doubt, M&A is coming. But first the market has to come back. As you know, I don't have to tell you this. The people are still not buying gold stocks. Everybody's sitting on the sidelines in GICs and other things. We need some certainty on the interest rate trajectory, and when that comes, I think that the capital will move back into the sector, and you'll see more M&A. But for us as a single asset developer, we can't rely on M&A. You can't force M&A. We've got to progress our standalone plan, and that's what we're doing.
Right. Okay. Single asset developer. I want to come back to that. I guess one question for a lot of the listeners who maybe they're not well versed in this, they see your grade 1.1 grams, and then they'll see the same grade at like a Canadian project, or they'll see that grade in Canada. And then, the market doesn't care at all, really. And then they see your grade in Namibia, and they might think, okay, well, what's the difference? Why is this 1.1 grams in Namibia, your deposit? Why is it so much better than in Canada or some other jurisdiction?
It's a valid question. Firstly, very important, you've got to compare apples with apples, geologically speaking. So when you compare our 1.1 gram, you've got to compare it to another project with similar geology, meaning disseminated, it's a haze. This is the exact opposite of a veiny type of deposit. Canadian retail loves the thin veins, like a meter at 20 grams, but often those things don't get mined. And when they do, they're high risk. You can look at companies like Pure Gold went bankrupt because they couldn't, they had high grades and they could just never achieve those grades. So the geological risk of the type of deposit that we have is much lower. That's important. Secondly, your question on how do you compare Canada with Namibia, a huge aspect, very important aspect that people forget is exchange rate and operating costs. Our salaries down here, people get paid in Namibian dollars or South African rand. That's like getting paid in pesos, and a large part of our operating costs are local. A lot of our supplies come from South Africa, etc. That's why our costs are low. I mean, the best comparison to us is the B2Gold mine, and the numbers are public. Their costs are in the $700-800 per ounce range, which is similar to us. And I always, I'm a mining engineer myself. I come from the industry. I still remember when gold prices were $300, then costs were $250. So $800-900 to me feels expensive. But if you look at the cost curve, it's actually exceptional. Cost curve is now sitting at 1,200, 1,300.
Right. Yeah, a quick follow-up on that. So let's say your deposit at, the AISC of 900, 950, whatever it is. If we plop that into Nevada, for example, with everything the same, would the AISC be like 1150 or 1200? Or, I mean, I guess it's hard. I mean, I don't know. Maybe you'd have to guess.
It's hard to say.
I'm just curious.
No. It's hard to say. Look, I'm shooting from the hip here. I would have to look into it to get exact numbers. But definitely, salaries is a huge one. But it's many other things. It's hotel rooms. When I travel there, I fall on my back when I see these costs. I mean, I took a I can't tell you who, but I took a very interesting group around Namibia last week, and we were sitting in a beautiful steakhouse, 8 of us. We had a couple of beers, we had a few bottles of wine, we had wonderful first-class food, and the whole bill was $500. And they told me that where they come from, or even in North America, it would have been 3 to 4 times that much. Another example is drilling costs. Our drilling costs are less than half, probably a third of what they are in North America. So that's why when you say comparing us with Nevada, you said 800 with us would be 1,100 with Nevada. I think that's reasonable. Probably worse. I think Nevada would probably be even more expensive.
Okay, just for the listener, we're just guessing. We haven't done the studies, but it's just like you said, you're shooting from the hip. But it gives a better understanding, because I think a lot of investors, they don't realize that when they're looking at these various deposits, they might think, oh, well, Nevada and Canada, they're great jurisdictions. I have to buy something there. And I mean, they, in many cases they can be. But anyway, that aside, one follow-up I had, because you were talking about it, the project can produce 170,000 ounces for 13 years. But you said if it's above 200,000 ounces, that's a tier 1 deposit. So why not try and make this a tier 1 deposit?
We can. Very simply, you haven't asked that question, but I'll give you the answer. We have a secondary project called Ondundu, which currently has a 1 million ounce resource on it. We recently published some stunning results from there. I think 110 meters at 2.2 grams or so. Real world-class results. That project is different to ours. It will require concentration, which can be done by gravity separation. It's a very simple, cheap and dirty way of concentrating that gold. We could then truck that concentrate to Twin Hills. It's about a 160-kilometer truck ride. It's not haul trucks trucking ore. It is smaller trucks trucking concentrate. It would be 3 or 4 trucks per day. With that, we could potentially produce another 50,000 ounces per year, which would get us north of 200,000 ounces. But all the disclaimers, this is obviously all speculative, because we can only talk about that once we've done a study on it. We're busy with that. But the real constraint is we're a single asset developer. So if we did that, we would load up on another 100, probably around about $100 million of capital. Our key constraint is capital, or the equity portion of that capital. And that's why we've got all these cherries on top. The 170,000 ounces a year for 13 years, that's an average. That to me is in the pocket. We will definitely achieve that. But there's significant upside. And I believe that this project will get to 200,000 ounces a year. And I mean, the best example I could use is the one that I sold to B2Gold. We did the study on it before we sold it. At that time, it was a 150,000 ounce a year operation. It has, since 2014, when they started producing, they've been producing between 180 and 200,000 ounces a year. Next year, it's going to be over 200,000 ounces. So these things are always better than their studies. The studies, by the nature of things, tend to be conservative. So this is an excellent project. It does have legs, and it's going to be producing soon, and will do very well.
So when you say these things, do you mean these types of projects specifically? Because a lot of investors are seeing a lot of projects that get worse, once a company buys them, and they have trouble.
No, you hit on it. It's a loose statement to say these things. But one of the major problems that we have as a company is the large degree of skepticism from especially Canadian investors. And the reason for that is because in Canada, there have recently been a number of very large project failures where the developers or the owners of these projects couldn't deliver these projects on budget and on time. I'll mention a few examples. IAMGOLD's Coté project, Argonaut, Ascot. If you add these up together, I don't know the exact number, but it's over $1 billion of shareholder value that's been destroyed. Pure Gold, I mentioned that earlier. There was $1 billion company that went bust. Most of them because of insufficient project controls, because of insufficient understanding of geology, etc. Now, along come we, somewhat arrogantly, even though we're not arrogant, we say we're going to do it better. That's obviously very difficult to bring across that confidence in a 20-minute interview. But I can say that our process, the way we've managed this project in terms of geology, metallurgy studies, the professional engineering groups that we have involved, the recency of the studies that have been done on it, we've done things by the book. And in fact, African projects, not just us, African projects generally are being developed similar to what we do. Same companies, same specialists, and African projects haven't had the cost overruns that you've seen in Canada. Most African, and we also haven't seen the inflationary escalation, price escalations. African projects generally have delivered on time, on budget, and I think we will be no different. But obviously, from the North American audience doesn't always differentiate, but that is key. Sorry, I lost my train of thought there a little bit.
Oh, no worries. Just a couple more questions, and I'll let you go. Maybe you could add a little bit more on Ondundu, the second project, because I know that you did have a really good drill result there. It's about 1 million ounces, 900,000 ounces. How is that similar to Twin Hills or different, and how can that add more value for current shareholders?
Yes, geologically, yeah, thanks for that question. Firstly, generally speaking, we get zero value for the exploration and the peripheral projects that we have, even though we have a lot going on. We've got Ondundu. We're talking to Newmont about a potential JV. We've done exploration in another area where we've got something very interesting brewing. With a bit of luck, we may have another discovery there. But the problem is at the moment the audience isn't there. No one is buying. No one is paying attention. You can see it in our share price. We've executed perfectly over the last year and a half. We really have done things flawlessly. We just haven't gotten the credit, and that's a function of the audience isn't there. There's no one buying these shares, and that's just the way it is. So we have to stick it out. Eventually, the market recovers, and then catch up will play. So I have no doubt that's going to be like that again this time. This business is cyclical. To come back to Ondundu specifically, it's geologically a little bit different to Twin Hills. It's not like Nevada. This is more veiny, more nuggety, higher grade, but also less consistent. That's always it always goes, one goes against the other sort of thing. Sorry, slaughtering the metaphor. When you have veiny, high grades, generally they are not as consistent, so there's more geological risk, but there's potentially more upside. So we are busy figuring that out. And then importantly, we're trying to figure out a processing route. I mean, we have already figured it out. We just have to do the test work and the drilling and the engineering studies to be able to talk about it, to add that to the Twin Hills production profile as a sort of year 3, year 4 production cherry on top. I think it would be a later year addition. That's the one option. The other option is, I mean, I don't have a map here, and it would be easier to show you on a chart. But that region of northeastern Namibia has a lot of action. There's Ondundu with 1 million ounces. An Australian company recently made a discovery. They added 1.3 million ounces for $2 per ounce discovery cost. Very, very efficient drilling. They did that in about 1.5 years. So that's not too far away. We have some very interesting other exploration cooking. So I believe there's a whole new district coming together. There's going to be a lot of action there. But for us as a company, we have to find a way to get value for that. Either by bringing those ounces to book in terms of our production profile, or potentially, and I've said this before, potentially spinning out those assets into a separate company and then shareholders get value that way. And in fact, we are actively working on that at the moment because we do want to get value for this. Eventually, shareholders will get value for this.
Tell me about the lithium project, because personally, as a precious metals focused investor, I don't care about lithium that much, but I know a lot of people do. So tell me why I should care about that, and as an investor in Osino, and why that's significant.
Yeah, very simple. So Namibia has plenty of lithium. It's got lithium production. It's got very conducive lithium geology. In fact, potentially, one of the Western world's, let me not exaggerate too much, but there's a company called Afriton, London listed, Very exciting. They've got a huge lithium resource they're busy developing. So there's plenty of lithium there. But we're not experts on lithium. It's a completely different kettle, a completely different game. So what you ask, why should your investors care? Well, we've attracted a top-class partner. It's a company called Prospect Resources, AISC listed. And last year, I think it was last year or the year before, they sold their Zimbabwean lithium project for just under $400 million to a Chinese company. Now, those same guys have become our partners. They're earning into our license. They're carrying us. We still own 50%. If they have success, we have success. And they are also looking for other lithium assets elsewhere. So for us, it's it's a no downside, significant potential upside lottery ticket that we found a good home for, whilst we can focus on our gold.
Excellent. Now, before I let you go, is there anything that we didn't cover that you think our investors and listeners should know about?
One thing, yes, let me emphasize this point. We are a very real company. I know the TSXV has a lot of, I don't want to call it pump and dump, but they've got a lot of dreams. And dreams are great. A lot of people love investing in dreams because it's exciting and so forth. And everybody wants to have the 5% chance of a 20 bagger or a 1% chance of a 20 bagger. But that is playing the lottery. Quite frankly, I don't like playing the lottery. For us, we are real. And I say that because we have a real project. We're real people. Our management team are subject matter experts in everything they do. We've proven that we're great explorers. We've proven that we can develop projects. And we're going to build this project. So we are going to deliver predictable returns. And that's much better. That's why when you look at returns, you can never look at returns without risk. Returns always come with risk or with probability. And I think our key here is that you've got a very high probability of an excellent return through us building this mine or potentially doing strategic M&A or whatever. And that's why I think we are an excellent investment proposition. We got great management, we got good assets, we got strong financial backers, shareholders. We've got significant avenues for growth through additional discovery and further drilling. And on top of that, our valuation is very low, so the downside is protected. I think that's the essence of Osino as an investment opportunity.
On that note, Haya, thanks so much for being the first Daily Gold public company interview. I really appreciate it. And hopefully we could do this again later this year so we could track and measure your progress, see how things are going.
Great. Thank you for having us on your show. We appreciate it.